Welcome everybody, it's another edition of Between the Lines Live. I'm here in Brisbane today and I'm joined with a couple of my colleagues here. So we've got Massie. Chris is a partner and director of RWC Northern Corridor Group, and also we've got Paul Anderson, director of RWC Queensland, in the industrial area. So welcome guys. So good to be here. We're going to be talking about industrial. It kind of feels like it's been a little bit too long. We haven't been really giving industrial the airtime it probably deserves. It's certainly been the asset class of choice over the last little while. I suppose COVID had a lot to do with that, population growth, demand for goods and kind of logistics and things. But can you give us the quick, I'll start with you, Paul, the quick kind of, what have you seen? Why do you think industrial has been so popular these last couple of years?
Yeah, so thanks, Vanessa. I think the start of the current run was COVID. E-commerce pumped, vacancy went down, rents went up. Also, a lot of capital came into the sector. Overlay that with the Queensland story, which is one of growth and a lot of prosperity, and it's become one of the tightest markets I've seen in 25 years.
100%.
Yeah.
Well, who doesn't love a shed?
Yeah.
Seriously, like for us that do it on the ground all day, every day, that asset class has proven the test of time. As Paul said, for the last 20 odd years, it's been the cornerstone of this part of the world for us. So It's been pretty good.
So, it has been, for a long time doing research in the industrial market, but there's been periods where it's been very stable and stayed, when doing long-term charts as a research person, a lot of staying the same for a long period of time, but we've seen kind of these real uptick in terms of land values, capital values, then going the other way, yields, rents, so much to talk about. So let's probably start with land. Across the country, it's not just a Queensland story. Land availability is becoming quite an issue. Vacancies are very, very low. So I might start with you, Chris. Where do you see, because you work more on the north side, where do you see kind of industrial land or what's going on in your neck of the woods?
Yeah, just going back to your initial comment there around the price, since 2008 when I started in real estate, the land price, which was relating to not only land, the rent prices and the sale prices of the assets, literally stayed the same for about 12 years. So you're $100 a square metre to rent, your sales prices were $1,500 a minute. It was the same for that whole period of time.
And can I just tell you how annoying that is as a research person doing a chart, because then it's this straight line chart, but it was quite exciting when we can start seeing it moving. So
yeah, and leading into COVID, probably the 3 years prior to COVID happening, we started to see that uplift. And it probably went in that 3 years leading into COVID, maybe 10 to 15% in whether it be rental or sales. And then we've seen that burst off the seams post-COVID as well. So we've seen anywhere from 20 to 30% uplift in land values and sale and leasing as well.
Wow.
So
have a similar story in kind of broader South East Queensland?
Probably two sides to this for me. So kind of from a legacy point of view, the Trade Coast is my main kind of area. Finding land in that market's like finding a unicorn, to be honest. So quite often people are buying an old shed, knocking it over. In Eagle Farm, the ones that I've tracked over the years kind of net back to $1,000 a square metre, but that's not there at the moment. So the next stop's out kind of Northgate, Geebung.
Is it not there because there's no product, or is 1,000 a metre doesn't work? What's the?
Well, there is no product.
Yeah.
So people aren't wanting to sell. There's a narrative around the Olympics. People are holding out for that. Northgate, Geebung, we did have an estate a few years back. So I'm thinking around 2020. My last deal there was at $600 a metre, and that's just before it pumped. I think today that would be $850, $900 a square metre.
Oh, yeah.
But again, nothing really in Geebung. Then the next stop's Brendale. I mean, where's Brendale at?
Yeah, Brendale, if you can find it, it's the same. There is a little bit of land there today and a little bit coming, but all reports you're sort of north of 700 a metre to find anything sort of sub a hectare.
Yeah, right.
So that's if you can find it.
So, but how about going further north? Is there land release? Is there, I know there has been periods of land release, industrial land release up kind of Sunny Coast way. Is there more land to come, or are we still pretty constrained?
Yeah, there's some coming. We're probably 3 to 5 years away before we see any general industry land. North Harbour are currently bringing some land on. So North Harbour is just south of Caboolture. They're bringing some MIBA zoning land on right at the moment. But if it's general industry, we've got zero there today, and there's 3 to 5 years away. For instance, you know, the Caboolture land that we recently sold at Corporate Park East, we sold those 40 lots in literally a day and a half. You know, once the developer said, can you get me some pre-sales, I rang him a day and a half later and said they're all done.
Wow. And so who were buying those? Just
It's about a 50-50 from owner-occupiers to developers.
Okay.
A lot of developers trying to secure land so they've got something to build for the next 2, 3, 4 years.
yeah.
And most of those developers bought multiple lots.
Okay. Which brings me to the whole issue of development, though, I suppose, is construction costs. Construction costs has been obviously a massive issue around the country, particularly COVID period through to now. Queensland's been particularly difficult. A lot of conflicting requirements for both goods and the labour for a lot of infrastructure projects, like you mentioned, the Olympics coming up. So how are you going with your developers? Are you seeing, like, there's a lot of stuff in the DA. There's a lot of kind of pipeline stuff that's just kind of sitting there. We know a lot of this stuff isn't going to actually necessarily, come to fruition. But what are you seeing with development? It's a little bit slow moving, or is it mostly the owner occupier people that are actually kind of taking the punt and doing the development?
I'd be interested to see what Paul says here, because obviously we haven't had the conversation, but I'm when I'm talking to those developers that are doing their feasibilities, they're having to guess the market in 12, 18 months, because it is still moving. We still haven't capped out our rental rates yet. Our sale rates will obviously follow. Yeah, we still haven't seen that finish, so they don't stack on today's numbers, so they're having to guess what the 18-month period will be.
But if they're an owner-occupier type use, like they want to develop it, is that like a sheltering from like rental growth? Are they looking at that option as opposed to buying the asset, or if you're an owner-occupier, you're jumping ahead and actually doing that kind of development?
Yeah, the owner-occupiers in that industrial space, they've had a pretty good run.
Yeah.
And most guys that own the small business, let's say small business, 5 to 100 employees, they've had a pretty good go.
Yeah.
They've got a bit of money in the bank, in their war chest, and they're wanting to get out of that rent cycle, a lot of them. It just comes down to whether they can find that unicorn, because that's the hard bit, is finding the land. Once you've found the land, it's not too bad. They're prepared to pay the tax of today's market to own their own. It's almost impossible to find something that fits their bill existing, so they do have to buy that land and build it. Whether that's, I guess in your part of the world, they're knocking it down to then build it.
Correct. And look, I had a bit of research sent to me the other day on the southern market, so this is kind of an interesting, just tapping back to land dynamic that I saw. Crestmead was selling between, which is in Logan, was selling between 400 and 500 a square metre, as opposed to the Yatla Enterprise market, which is trading between 500 and 700, which seems more in line with what you're saying. I just wonder if the market's putting a higher value on the connectivity to the M1.
Yeah.
Yeah, I think it is for sure.
Yeah, for sure. I think historically, we've always seen that, particularly if you're looking at, I know we've been talking about the smaller size stuff, but the big kind of logistics need the access in and out. Like historically, we've seen that kind of, that appeal of those sort of locations. But how about the development market in I understand it's also pretty tight, but...
Yeah, so to your point, like, I've got clients that are looking at sites now, and they're looking at them at the $600-700 a square metre, and they're thinking to themselves, well, and I'm just going to wind this back to 500, so it's easy maths on this piece. But if you buy a block at 500 a square metre, you generally get a 50 to 60% site cover. So you times that by 2, it owes you $1,000 a square metre on your building footprint. And then you load in your build price of 2,000 a square metre, so you're at 3,000 a square metre. 10% in minutiae, so 3,300, which includes headworks, agents' fees, holding costs, and then these guys don't do it for free. They want a 20% margin. So we're at $4,000 a square metre. Generally, the only product that works at that level is strata or multi-tenancy. And I think there's a little bit of pause, and people are just looking to see what happens, probably to your point, in the sense that, are you confident to bring on a strata project now? Maybe if it's small enough, maybe if you've done your research and there's not an oversupply in that area already. Those are the factors that I'm starting to see come into play.
You mentioned some assets that are like either been purchased and then kind of bowled over to possibly build something new. But are we not saying, given the high cost of construction, that perhaps that kind of vacant built form is kind of attractive to some investors, something that's already there and they can kind of add to, or, is that a thing? Because I know
Yes.
certainly in Sydney and stuff, like the built form is king because of the high cost of construction. So is that similar up here?
Look, it definitely de-risks it on that level. And I think, given the current conditions, people aren't hesitating because they don't think the sky's going to fall in. It's more a hesitation around, getting in and controlling costs. So if you can do that with an existing building, 100%, it's a good idea.
Yeah, the smart investors are definitely looking to purchase existing because you can't replace it for what
Yeah.
they're buying it for.
That's it.
We're still seeing those rents increase for that reason. If you build a new, 1,300 square metre box, we're chasing 160 to 180 a metre for it. The existing tenants out in the market are paying 140, 150. So
Yeah.
there's that 10, 15, 20% missing link between new and old.
We'll come back to rents, but if I just kind of double back to the whole issue on the strata. So we saw investment activity over the last number of years particularly high when interest rates were nothing.
Yep.
We saw every man and his dog jump on the bandwagon, buy something, and industrial was certainly the flavour of the not even month, year, 2 years, all the way down to that small industrial sort of thing, either own occupier or investor, through to institutions really getting in and buying those kind of huge logistic facilities, offshore buyers buying cold storage. It was quite big numbers. However, interest rates going up. Again, we got another interest rate rise yesterday. Melbourne Cup interest rate rise, yay. What does that mean? And we've seen volumes this year particularly low across the board. Industrial is still probably the number one investment choice, though. So with looking at that strata piece, with this big increase in the cost of financing, I'm assuming we've seen a lot of investors jump out of the market.
It's interesting. I think we're going through a once-in-a-generation transition of wealth. So you've got the baby boomers that have a lot. They're in the market at the right time. They've accumulated assets and they've got a lot of wealth. The groups that I'm dealing with aren't really worried about interest rates.
Okay.
And it's not to say that that's not a part of what's going to happen going forward, but I think there's an ultimate supply issue in Queensland from an industrial perspective, which will buffer probably that concern.
Yep, I agree.
Yeah.
Yep.
How about institutional activity? I know that it's not necessarily a space that you guys operate in, but we've seen definitely that end of the market come off in terms of transaction activity. There's a few assets kind of coming to the market. Do you think that will, it's the same sort of thing. There's this kind of constrained supply. It's still high, occupancy is very, very high. Rental growth, albeit reducing a little bit, it's still going in positive direction. Will there continue to just be demand for these sort of assets?
I'm kind of hearing, because as you said, I'm probably not active in that space, but what I'm hearing from my colleagues that are is people are starting to consider to sell at book value, not because they think the sky's falling in, but because the debt position and the debt package behind it is starting to change. Rates for them have gone from 4 to 5% to 6, 7.
Yeah.
And it's just kind of impacting the overall deal. But, I haven't seen much come to market. Charter Hall have sold a couple of things in Eagle Farm that were part of a smaller portfolio. And look, they bought the portfolio pretty well and they've sold well, so they've made good money. They're doing other things. Look, I just think it's a great story. I mean, our market is really tight and I think it will stay that way. And the groups that sell, I think they'll get good prices.
I think in my part of the world, being in Moreton City, I won't name them, but all of the instos, the usual suspects for large industrial land holdings, are literally knocking on my door most weeks. They're trying to buy. There's 3 or 4 parcels that are that 300 hectares. They are looking. They've probably missed the boat by what they could have paid for 3 or 4 years ago when we started saying, hey, you should be here, it's coming.
Yeah.
It took them 3 years to go, oh, it's here.
Yes.
That's, they'll still purchase that land, but they missed that boat by 3 years, I guess, because I sit and live it and breathe it and know what's happening within the Moreton Shire, and the 70,000 people moving into the back of Caboolture and Morayfield West, that's 22,000 homes. All that stuff is now out in the market. We all knew about it, 5 years ago, but they weren't prepared to act at that point.
Yeah, right.
So, there's so much going on in that space, and there'll be some big stuff come out in the next 1 to 4 years. You'll see it.
And so if you're talking about that sort of kind of investment stock, then we're talking kind of a yield play. Obviously, yields got to certainly yields that none of us have ever seen in our property careers in industrial. They've certainly come back because just the calculations don't work anymore. Do you have an opinion on kind of where they are, or do we think we're going to move very much? Like I said, interest rate announcement again yesterday. Are people investing in these assets looking more for the longevity of the asset and the future kind of income that is expected to remain for industrial?
I'm seeing people looking for value, and I mean, a site at 4% leased at 120 a square metre is still cheaper than a site leased at 200 a square metre at 7%. I think sometimes the headline yield probably doesn't convey what the opportunity is, and people
100%.
buy property for the opportunity. At some stage, they want to exit the asset, unless it's an intergenerational holding. So you're looking for that capital growth, and I think if you get away from the yield to where it's leased at, is there uplift in the rent? And underlying all of that, sometimes you can get a really good yield, but it's super high risk. It's a bit of a pig. So
A bit of a pig.
yeah,
Is that a technical industrial term?
yeah, it is. Yeah.
I'll leave it
That's
to you.
a South East Queensland term?
Well,
Alright.
It's just basic economics.
Yeah.
The higher the risk, the higher the return, basically.
And I suppose also we spoke about kind of short WALE assets as well. Like historically, that would not be what people would go for. They would be looking for that kind of long, stable income. But given the huge uplift that we've seen in rents, there may be some assets out there, like you said, that are under rented. So, they seem like good value on a short WALE.
Yeah, and look, it kind of does my head in. I mean, go back 5 years, improved rate per metres were less than 2,500 a square metre. And as we've aforementioned, they're coming out around 4,000 a square metre, and beyond that. Where does it go to? I actually don't know. I mean, I think we're starting to challenge C-grade office space in terms of rates.
Oh, well, that's a whole other discussion.
I don't see that in my area, but
You're seeing the same sort of thing in terms of that kind of rental space, people looking at investing in these kind of short WALE opportunities?
yeah, I think the high net worth people that we deal with, they're smart enough to realise that those assets that have short WALEs, there's enough uplift in it for them, and they know they can't buy something new existing for the same price. So they're actually buying it at a discount, and they're looking, going, okay, today I'm going to get my 6.5%. I know that over the next 3 to 5 years, I'll turn that into a 9 and 10% returning asset, just by waiting for the rent uplifts.
So I'm talking in the rental market. So who's leasing this space? Like we know at the big end of town, we've got all those kind of distribution, logistics, storage. Like you said. South East Queensland, massive population growth. It has for the number of years. Like you've got population from those southern states, continues to happen now. Our immigration is, tap is well and truly turned on, and a big proportion of that's coming up to Queensland. Our requirement for goods is not going away, like in terms of fresh food and the storage and distribution of goods. So who else is there other than that? Like these smaller end of the market, who's occupying this space?
Outside of the local guys, the usual suspects, I've personally seen a migration out of Melbourne. Business owners that have large facilities down there, moving their facilities up here. Various reasons, they want to live in the best part of the world. They can also get workers. They're struggling to get workers down in Melbourne.
Okay.
They are struggling to understand our pricing.
Right.
Because their pricing is a lot lower than what we're seeing
Well, they've
here.
got so much more land down there.
So, the first couple of conversations with those guys is, you're kidding yourself, it's too expensive. By the third conversation is, which parcel can I buy?
Yeah.
And I want to buy some more, and they're bringing up, like, 3 or 4 guys have done some transactions recently with, that are bringing 3 or 4 businesses. So they're not guys that own one business, they'll own a number of businesses.
But what sort of businesses are they?
Those particular ones, quasi-manufacturing.
Okay.
So more assemble. I mean, we don't manufacture in this country. We just put it together.
Yeah, I think through COVID, another fallout of COVID was, the country started to consider their sovereign manufacturing position. If we can't get the stuff, how are we going to get it? So, you look at things like essential medical, military equipment. I'm actually hearing groups like Nyla, looking for more space. So it's an interesting thing to see, because we've had 2 decades of losing manufacturing, but now it's starting to return.
Yeah, I just did a piece that was in Real Commercial, I think it was
We
the
have,
other day. That kind of resurgence in that kind of small manufacturing is not to a huge extent, but it's certainly back.
Just makes sense too, like from a carbon footprint point of view too.
In our part of the world, we've got, this is a stat I love to talk about, I've got across a range of different properties, we've got 12,000 square metres under roof of strawberry punnets.
Oh.
Because, we've got the food basin just out behind us. So those guys were bringing it all in from China.
Yep.
a lot of those are Chinese companies. They're actually doing it here now. So they're not actually bringing the punnets in containers. They're actually pressing them on site.
Oh,
There you
okay.
go.
And
A lot,
how
of,
about-
lot of strawberry punnets.
And well, there's a lot of strawberries out at the moment. But also the looking at the kind of small industrial, these kind of owner occupiers. Is there any particular industry? There's a lot of kind of construction, I suppose, taking up a lot of that space. Is there kind of, because we saw an awful lot of new business start to kind of jump up, particularly in Queensland during the COVID period. A lot of them have probably taken up small spaces, industrial spaces. Is there anything in particular that those uses?
We did a project recently at Hurston, and the style of buyer was actually small kind of e-commerce brands.
Okay.
Yeah.
A little bit of allied health as well. Interesting from their point of view is they'd like to buy a strata industrial so they didn't have to share a foyer with other tenants. So, we're seeing that high-tech industrial really come into play, which is good because it is the best way to kind of crank your fees out to make the deal work.
Yeah. We're seeing that sub 300 square metre shed, predominantly tradies.
Tradies,
They've had a good run last few years. They've got their money, their accountant's saying, hey, you need to put that somewhere. So
Self-managed super fund sort of thing.
yeah, a little bit. It's not the flavour of the month like it was a few years ago.
Yeah.
There is some of that
Jet
going on.
skis in there too.
Correct. They put their jet
Which brings
skis
me to
and-
the man cave thing. Like man caves, particularly up your neck of the woods, there was quite a few kind of those developments going on. Are they still got caravans and jet skis in them, or?
If the people are smart, they're taking their caravans and jet skis out. But yeah, we have pockets. I think we were talking about the foyer there before. Like North Lakes, for instance, they're quite sought after because everyone lives in North Lakes, small block,
Yeah.
lots of income, so they need to put their toys somewhere. You go down the road 20 minutes, and everyone lives on an acreage block. So
Yeah.
it's a bit depending where you are, but I imagine yours is a whole lot different.
Look, I don't have much exposure to this market, but I am trying to get out there and network with our team a bit. So I was speaking to Jack Wynn and Harry Egan, the younger guys in the market through the franchise network, and they're saying it's quite bullish. It's strong. And I think Jack's doing a project now, and he's already got 5 million pre-sales, but the thing won't be finished until 2025.
Yeah, wow.
So look, it's there. Yeah.
Okay, well, we're actually nearly out of time, believe it or not. We could have talked about this for an awful long time, but industrial certainly, well, it's not going anywhere. Like you said, the constrained nature of our land, the land supply here in South East Queensland, the demand is going to continue, particularly with our population growth. New business start growth is going to continue. We're going to see uplift in rents continue again, just because of the whole vacancy, supply and demand fundamentals are at play here. So, knowing all of that, what do we see as an opportunity maybe for 2024? Start with you, Chris.
Is this the plug for the land
Oh,
I'm
no,
selling
you
in
can-
Old Bay Road?
you can-
542 Old Bay Road, guys. 8,000 under roof, DA approved, ready to go. Look, no, there's. I think there's lots of opportunity. I think you've just got to be a bit smart with where you're looking and what you're looking for. You've got to turn over a few more rocks. I think if I'm looking in the market, I'd be looking at existing.
Existing stock, just the cost of construction just doesn't make it.
Yeah.
Yeah, okay.
And function for me, it's always function. You got to have the right amount of power, the right amount of roller doors. Is it high enough? What's the access like?
Yep.
All of those 1%.
Well, those fundamentals that a lot of people probably during the height of COVID, when interest rates were nothing, and we saw the investment turnover levels particularly high. Some of those fundamentals did go out the window.
100%.
So it's just going to go back to those sort of things that we historically have
Yeah.
looked for, and just
Yeah.
sensible.
Yeah.
Sensible hat on. I've said that a lot in a lot of my reports. Sensible hat.
I think if I'm looking right now, I'm looking for two things. Firstly, I'm looking for a modern building, semi-modern building, 1,000 to 2,000 square metres in size. I'm looking at the rate per square metre, not the yield. So anything sub 3,000 square metre, I'd be looking at that really seriously. And then I'm looking for, sites 2 to 4 hectares, infill, quarry kind of locations. Maybe you drop a road in and you put some, subdivision through it. Maybe you sell some of the blocks, maybe you build on them. I think the people who have the skill set to do that will really capitalise on the fundamental land shortage.
So do you think that they're going to be the clever, high net worth, cashed up investor?
Look, with the right consultants, that's definitely there. Typically, you see the groups that have that internal capability to coordinate that really execute well, and that's what it's about. Sometimes you can not do it well and it takes forever to get something through, but the groups that have that internal resource can really take advantage of a shortage.
So back to fundamentals and infill modern facilities, your calls for the next year. I just want to, one more thing before we end up, is something a lot of people have been asking me about. Well, there's two. One is self-storage,
Yep.
and the other is cold storage. So let's start with self-storage. You've done a little bit of, know a little bit about what's happening with self-storage. Institutional activity particularly high, particularly in infill areas or kind of a very built-up areas, this requirement for storage, because that's like the residential market is faced the same dilemmas as we are in industrial. Land supply is tight, housing supply is difficult. It's an asset class people have been looking at more carefully.
Yeah, there's a number of groups, and as you said, there's some institutional groups. The thing that I've noticed is not all groups are after the same thing. So some guys have a model of having, metal clad sheds in the middle of nowhere where people can drive in. Some groups like to be everywhere on a national footprint, including vertical storage.
Yeah.
And they'll pay, 20, 30 million for a facility. The one that I'm working on at the moment is with a bit of a local success story, and they're looking to expand. I think they've just raised $100 million to fund projects around the country. And I think the thing that is changing is the debt package for those groups does impact the overall cost. So that may mean that the land values in those deals come down. And we have seen that in large format retail. So in some regards, the industrial land's worth more than the LFR land, which
It's unusual.
feels
Yeah,
like...
historically we haven't seen that.
feels
And cold storage, we saw a lot of kind of offshore groups come and actually invest in that part of the market. Our requirement for strawberries and for fresh food, and also there's that pharmaceutical piece that a lot of people don't even consider, like that's all cold storage. Have you seen much with that, or is that's pretty tightly held part of the market?
Only in owner occupiers from my side. There's been quite a lot of owner occupiers, i.e. strawberries, those sorts of fruit and veg.
Yeah.
But there's also that market making sandwiches to the supermarkets. So that actually food manufacturing is something that's, I'd call that booming in South East Queensland.
Yeah.
Definitely our team up the sunny coast have seen quite a bit of that go on. I'm seeing it now in and around the north side of Brisbane. I've got a few groups looking to acquire, and they're going to have to retrofit something generally rather than build. They're starting to want to buy land to build, can't find it, so finding them something that they can retrofit. So yeah, it's definitely there. Not so much for the big boys from my side, but the middle tier owner occupier business is definitely in the market.
Look, I think it definitely got institutional attention, that asset class, and those groups don't engage unless there's really something to it. So I think certain people identified there's a massive shortage of that type of thing.
Yeah. They're expensive.
I think the beautiful thing about the deals that can be packaged is they're super long term, 20-year leases, etc. So, yeah, look, it's not my specialisation, but it's certainly an element of the market that's going very well.
Yeah, for sure.
All right, I think that takes us to an end of talking all things industrial here in South East Queensland, and just keep an eye out for some of those, what's going to go ahead into 2024, and sensible hat on, and some infill assets would probably be the flavour of next year, not just the month. But thanks, guys. Thanks to Chris and to Paul for joining us today. I hope you all got something out of it. As always, like we started last month, this can be listened to on Spotify. So jump on Spotify and search Ray White Commercial or Between the Lines Live and listen to this, and listen to all of our past ones and see how right or wrong that we got it. So thank you again, guys. We'll see you next month on the 6th of December, where I have a one-on-one with Pete Vines from our Western Sydney office, and we're going to talk about what's happened for the year and what we're probably going to see in the year ahead, our kind of projection, so you don't want to miss that one. So thanks for joining us, and thanks, guys, and we'll see you next month.
Thanks, Paul.
Thank you.
Thanks, mate. Good to see you.